You want to be a great investor? You're going to have to be great at analyzing companies, and who says analyzing says tools and indicators. In today's video, we are looking at the most important indicators in value investing. Don't miss out. Investors use various metrics to attempt to find the valuation or intrinsic value of a stock. Intrinsic value is a combination of using financial analysis such as studying a company's financial performance, revenue, earnings, cash flow, and profits, as well as fundamental factors, including the company's brand, business model, target market, and competitive advantage. These indicators will help you get a better grip of how well the company is doing. There is a lot of metric used, but to keep it short, these are the most popular ones. Price to book, PB, or book value, which measure the value of a company's assets and compare them to the stock prices. You can get the PB ratio by dividing the stock price per the book value per share. The book value per share can be obtained by dividing the book value per number of shares outstanding. If the price is lower than the value of the assets, the stock is considered undervalued, assuming the company is not in financial hardship. Second, price to earnings, PE, which shows the company track record for earning to determine if the stock price is not reflecting all of the earnings or is undervalued. You get the PE ratio by dividing the share price per the earning per share. The earning per share can be obtained by dividing the earning per share by the number of outstanding shares. Stocks with low price earnings ratio historically have outperformed the overall market and provided investors with less downside risk than the other equity investment strategies. For example, a company with a current PE of 20 trades at 20 times earning. The high ratio indicates that investors expect higher growth from the company compared to the overall market. A high PE ratio does not necessarily mean a stock is overvalued. Any PE ratio needs to be considered against the backdrop of the PE for the company industry. For example, the average PE ratio of the popular index SP 500 is 15.97. As a rule of thumb, a stock under a PE ratio of 15 is usually regarded as undervalued. More than 19 is often regarded as overvalued. Don't forget that this rule is not to be taken literally. PE ratio is a part of the value analysis. It also changes a lot between industries. Free cash flow. Free cash flow is the cash remaining after expenses have been paid, including operating expenses and large purchases like equipment or upgrading the manufacturers. Strong cash flow gives a company greater financial flexibility. When paired with capable management, it can be the foundation for stronger earnings and higher stock prices. Debt to equity ratio, DE, is a stock metric that helps investors determine how a company finances its assets. The ratio shows the proportion of equity to debt a company is using to finance its assets. You get the DE ratio by dividing the total debt by the total shareholders' equity. A low DE means the company used a lower amount of debt for financing versus shareholders' equity. A high DE ratio means the company derives more of its financing from debt relative to equity. You see where I'm going with this. Too much debt can pose a risk to a company if they don't have the earning or cash flow to meet its debt obligation. As with the previous ratio, the DE ratio can vary from industry to industry. A high DE ratio doesn't necessarily mean the company is run poorly. A DE ratio of around 2 or 2.5 is generally considered good. This ratio tells us that for every dollar invested in the company, about 66 cents come from the debt, while the other 33 cents come from the company equity. And the last one for today, PEG ratio. The price earning to growth, PEG ratio, is a modified version of the PE ratio that also takes earning growth into account. The PEG ratio measures the relationship between the price earning ratio and earning growth. The PEG ratio provides a more complete picture of whether a stock price is overvalued or undervalued by analyzing both today's earnings and the expected growth rate. Typically, a stock with a PEG of less than 1 is considered undervalued since its price is low compared to the company's expected earning growth. A PEG greater than 1 might be considered overvalued since it might indicate that the stock price is too high compared to the company's expected earning growth. Since the PE ratio doesn't include future earning growth, The PEG ratio provides a more complete picture of a stock valuation. The PEG ratio is an important metric for value investors since it provides a forward-looking perspective. Of course, there are many other metrics used in the analysis, including analyzing debt, equity, sales, and revenue growth. After reviewing these metrics, the value investor can decide to purchase share if the comparative value is attractive enough. Of course, investors can have different interpretation of the different metrics that I gave you. For example, one investor might like a company with a higher PE ratio than another one because of a handful of reasons. I gave you the general idea of each one, but you will develop your preference over time. As always, comment, like, and subscribe if you've liked the video and want to be a better investor in the future. Have a great day.